And would it make sense to look at other alternatives compared to what traditional advice says? Because traditional advice says you need the maximum rate of return of your money, that the biggest pile you have is most important. But what if where your money is more important than what it earns, and you can avoid all the taxes involved? I still think that there's an unnatural relationship between the U.S. national debt and Wall Street, because the national debt keeps getting to higher ends, and so does Wall Street. Doesn't always make sense to me unless you start thinking, gee, they might be in cahoots together. Yeah, you know, I think that ERISA was set up to do that so that you can have tax deductible dollars going into Wall Street. And then if you don't put money in, you're going to be left behind, or at least that's the common sense thinking there.
Yeah. Well, I mean, one of the interesting things about those types of retirement plans is that you're putting money into an account that you have no idea what it will be worth in the future. First off. Second off, you're deferring taxes now at a known rate to pay taxes on an unknown rate in the future. So, not only that, the tiny amount that you put into your government sponsored, tax deferred retirement plans is much smaller than the amount that you're going to withdraw and the government is going to collect on once you're ready to start withdrawing and paying taxes on it. So the government is actually banking on the fact that they're going to give you a tiny tax deduction now to get the maximum deduction out of you in the future. So who does that sound better for? You or the government? Just something to think about.
Yeah, when we start really putting the math to everything, it's actually pretty shocking. And when I look at a little bit at the solution here, when we look at the capital equivalent value of our solutions, where you have less money, the dollar amount is lower, but it generates far more certainty, far more security, and greater opportunities.
In fact,
It's a
the rate of
win-win-win.
return. In fact, the rate of return is negative often.
It's negative for the first 10 years. You might break even. I think you break even the 11th year, which is okay. But yeah, it's negative, and yet you have all the liquidity, use, control. You have access to the funds, and you're in charge. So, in fact, I had a website. I don't have it now because I'm too busy. I can't develop anything anymore.